Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. All the comments and subscribers, I greatly appreciate it. This week, Micron Technologies, the fourth largest semiconductor manufacturing facility in the world. We're going to take a look at their financials. We're going to look at 9 years of history. We're going to take a look at that patterning and see what we think that business can yield on cash flow. We're going to forecast that cash flow forward. Then we're going to take a look at the stock price today and figure out if we buy it now, what can we earn by holding it over a decade? You ready? Let's get to work. Okay, like always, before we dive into the 10K of Micron Technology, let's go through the 5 key attributes of rational investing, right? So what do we look for? We look for a company that's got top line revenue growth. We want to see earnings growth. We look at enterprise level earnings, so that's EBITDA or operating income, but EBITDA is the one we choose. We want something with strong free cash flow. We want something with low debt that's less than 3 times debt to EBITDA, and we want a well-priced stock. For us, we use well-priced being enterprise value to EBITDA. We also look at free cash flow yield, but either of those metrics work to tell us that given its history, it is underpriced for where it should be trading. Behind me is the 10K for Micron Technologies. Please print it out and read it. I love reading 10Ks that come out once a year. Read them. They're a great source of unbiased, unfiltered financial and business information on the company that you're interested in looking at. Behind me is Micron Technologies. First thing I want to do is pull up the first page, give you a real high level of what the company is. They are the 4th largest semiconductor manufacturing company in the world. They have 44,000 patents, okay? They're in 17 countries and have 13 manufacturing facilities around the globe. It's right here. Now, I've gone through these 10Ks and I've pulled out for you financial information so we can take a look at the business, how it's performed over the last 9 years. And then that would give us some kind of foundation to forecast the future. We'll also look at their most recent management presentations to see what management's talking about in the future. And we will smell check it for ourselves based on the history. Can they do what they're saying they can achieve? And that's our job, really. It's to take the information that they're giving us and test it against history to see if it's possible, if we believe it to be true. So let's go through the historical financials for Micron Technologies. We'll then take a look at what they're saying they can do and see if it's possible. See what the numbers pencil out at. So here we go. Revenue 2012, $8 billion of top line revenue for the company in 2012. And that grew steadily to a peak of 2018, $30 billion. Did I say 8 million before? I meant 8 billion. And it grew to $30 billion over that time period. But then, very noticeably, it falls really quickly and very fast. And that's concerning for me. It makes it much more difficult to forecast a business if you have this kind of up and down. And when I read the 10K and I pull out some detail of what's going on, revenue declines in 18 and 19 due to price driven. It's price per unit driven. So it's and then gross margin declines with prices from 50, gross margin declining here from 59%, which is a very strong gross margin for a manufacturing facility, to 30% in 18 versus 20 respectively. So here's your page numbers on the 10K. That's 36 of the 10K or 36%. That's the management section. They're just calling out what's going on. Other thing is the U.S. Bureau of Industry Security stopped sales to Huawei in late 2020. Huawei represents 12% of revenue in 2019. So they've got some headwinds here. R&D costs go up 7%, largely because they're just investing in more volume of R&D. And then SG&A increased mostly because of higher comp. So they're telling you what's going on in the business and they're explaining what's going on here. This is price driven, it's not unit driven. So they're still moving a lot of volume, but the volume they're moving at, they're selling at a lower sales price, which is kind of like a commodity business, which is not great, right? You want someone like an Apple who can charge a premium for the company, for the product, and yet people still demand more. Here it's kind of the opposite, where they're subject to the supply and demand of the market, and they are actually saying that there was a supply and demand imbalance here, which caused precipitous price fall. And you can see that carried through to EBITDA. So EBITDA was growing nicely, 1.5 billion, 2.5539, and then it starts coming off in here. It came down here too, but $19 billion is a monster EBITDA print on this $30 billion. That's incredible, but it peels off very quickly to a cool $8.7 billion. And this drop is substantial, right? That's more than a 50% haircut in profitability over the last 2 years, which is alarming, and it makes it much more difficult to forecast where this business is going because it's not a nice smooth line. That should be an alarm bell in your mind about how when you forecast something, the more consistent that cash flow, the easier it is, the more confident you're going to have in the forecast in the future. Noise like this with ups and downs, it doesn't mean the future isn't bright, it just means it's harder to predict. So, but it does check both boxes for us in terms of top line revenue growth. If you held it for the decade, the 9 years, revenue grew at average of 13%, EBITDA margin of 24%, very strong double-digit numbers, good for them. Now let's continue to look at the rest of the EBITDA stack up. So long-term and short-term debt, they do have some. It was growing as the EBITDA was growing, and then when they had that peak year, they bought down a lot of the debt. They used a lot of this profit to buy down debt, which is fine, and they're now at $7 billion of debt. They have a little bit of excess cash, and then here's your market cap. Again, average shares outstanding times price each year. Market cap went from $6 billion to $60 billion, a good 10x on the return, which is fantastic. But then it peaked and it dropped. Interestingly here, market cap pulls off $10 billion, right? 60 to 50, when profit collapses from 19 to 8. So 19 billion of EBITDA down to 9 billion, more than 50% reduction. But market cap, the stock price, does not fall 50%. It peels off, what is that? 10 into 60 is like 15, 12% drop. That to me seems like a little out of line. I would have liked to see this number be marketably lower than here given the profit drop. But let's keep going with our metrics. So EBITDA, enterprise value to EBITDA, right? Our relative value measure that we use EBITDA as an enterprise level earnings. 6s, 4s, super cheap here, and then kind of come up to 6.5 last fiscal year. Currently, it's sitting at 11 based on forward EBITDA outlook. You're paying 11 times, which is materially higher than ever it has ever been in its history that we can see from here. So I think this to me is a little bit of an alarm bell that it might be testing the limits of its valuation at this point, but we'll see what the growth forecast looks like. The rest of here, the debt is fine. Debt is less than 3 times enterprise value, which is what we looked for just to make sure we can protect ourselves. All right, let's take a look at the cash flow statement for Micron Technology. I think this is going to be the big thing, right? Remember, what do I say about the big companies that have large CapEx expenditures? Well, they trade at lower EBITDA multiples because that EBITDA doesn't represent true cash flow because they have to invest in CapEx. We're going to see that right now. Cash flow from operations, right? The top third of the cash flow statement, $2 billion to 5 to 8, peaks at 17 billion right when our EBITDA was peaking, and then it comes down to 8 billion. This is perfect. You want to see an EBITDA that and cash flow from operations that follows each other in a pattern. If EBITDA is rising, you would expect cash flow from operations to rise. If EBITDA falls, you would expect cash flow from operations to fall. What happens a lot is that accounting and finance teams get pressured from the market and they start disjointing those two, which is a no-no. So we really want to make sure that that's clean. It's just a small smell check. It's not perfect by any means, but it's a small way of checking that they are expensing things properly and that they're being recognized in the cash flow statement. Now, this is cash that they generate from selling their DRAM, from selling their NAND. This is the cash that they bring in from engaging in business. Now, what do they do with that? Well, they have to put some of it back into the business for growth and to maintain their equipment. Now, these guys have foundries, big manufacturing facilities, and that takes a lot of money or capital to keep it up, keep it going, expand it, build new ones. They're very, very expensive. So what happens is this CapEx number, the property, plant, and equipment, is a big, big number. And you can see, I like looking at the percent here, the relative numbers between how much they generated, $2 billion in 2012, and how much they had to put back in the business just to grow, not to just to grow, but to grow and to maintain what they have. Make sure all the conveyor belts are oiled. If something breaks, they're changing it. If they want to expand into a wing because they have a new customer, well, they got to go build that wing. That takes cash. So in this instance, they made $2.1 billion. They put back $1.7 billion. So what is that? That's only $400 million that they actually got to keep and do something with outside of reinvesting for growth. So that's an important ratio. And I look at it over time, and what you're going to notice is that it's largely similar. They had a monster pop here where the margin really widened, but then it quickly collapsed back. And last year, they spent almost all of their free cash flow, like cash flow from operations in CapEx for growth. I'm not knocking it. It is a growth investment. It's also investment to maintain, but it can't be used to go acquire businesses. It can't be used to buy back shares. It can't be used to dividend. And it's kind of an obligation to keep the machine running. So just bear that in mind. But that is a big, not flag, but just a concern that you want to realize. And it's also why this company trades at a smaller single-digit EBITDA multiple. Because again, EBITDA isn't free cash flow. You have to invest in the business as part of the DNA. So that's why these are single digits, not the 20 digits, not the 35, 40 that you see in software companies, because software doesn't have much CapEx, and so all the EBITDA mostly translate to cash flow from operations, which mostly flows through the free cash flow. So for us, we got the cash flow from operations. We just check that box. That's growing. We've got CapEx, which is a lot, but it's still positive. Then you have to make debt payments. You saw that they don't have too much debt. It did grow as EBITDA and free cash flow was growing. These are largely positive. Then they had that windfall of cash. They paid down a huge chunk of debt, and then they've been borrowing slightly the last couple years. But what I'm principally interested in is the sum of all this. This column, our free cash flow to the equity holders, the people buying the actual stock. That's what we want. This is what the company is valued based on. And when I look at this number, it's largely meh. I mean, aside from a couple years that you get really big pops, you got some negative numbers in here, and you've got relatively unimpressive numbers on low years where they don't have the pricing power that they need to be able to sell their product at a premium. They get a lot of the cash flow is sucked up with CapEx, and it doesn't leave much for the free cash flow calculation. So then again, you take your shares, you divide free cash flow by shares outstanding, and you get free cash flow per share, 65 cents. Some negative, some positive, not really growing, just kind of bumping along, which is not, it's not here nor there. There's just no real pattern here. So it makes it very difficult to forecast. I will also note that the shares are slowly growing over time. And I think that's because you've got share-based comp that they give employees. We make a couple acquisitions every now and then that you have to use shares for because you don't have the free cash flow. And the shares naturally grow over time, which is dilution to you and I who buy the stock. And what I look for on this channel and in my personal portfolio is a company that generates a lot of free cash flow, buys back their own shares, makes acquisitions, gives a dividend out, but a business that fundamentally can throw off a lot of cash flow. And this one seems to have to put a lot of cash back into the business. Now, that's also a moat, right? Because once you build a giant foundry, it's very hard to compete. It takes billions of dollars to go compete against the business. So I'm not knocking it. It's just, it is what it is. It's the state of the operation. Lastly, free cash flow yield. You're looking at kind of mid-single digit, if not low single digit. This is 7.1. I think that's largely affected by this 12 and this 30. If I were to exclude those, it would be a whole lot less than that. Let's just see what that looks like here, like that. That is an average of 3%. So it's got kind of a 3% yield if I pull out these numbers, and it seems like cash for me is a little tight, maybe a 3-4%. So it's a low single-digit cash flow yielding enterprise. Okay, now how do we forecast? So that's the overall business. Kind of you get some cadence for. It seems like it's very price sensitive, right? They don't have pricing power. If they're saying revenue fell because of supply and demand imbalances, that means it's kind of a commodity-ish. They've got a moat because they've got the foundry, but at the same time there are other people making product that they have to move. So it's a little bit of a buyer's market out there. So what I did is I pulled up one of the most recent quarterly investor presentations that they have, and I flipped through it, and sure enough, they gave me a couple pieces of information. One, the revenue mix between DRAM and NAND. It's a 70-30 mix. DRAM 70% of 2021 revenue. NAND is 30%. And they also give me long-term CAGRs, the consolidated average growth rate, or the compound annual growth rate, 30% for the NAND, and the mid-high teens for the DRAM. So doing a quick mix, I just took these are revenue proxies. So here's your 70-30 split. Just if this was in billions of dollars, this would be hypothetically 700 million, 300 million to give me the 70-30 split of revenue for one. And I took the growth rates that they gave me, mid-teens, 16 and 30, ran it out for the entire time. I didn't haircut it, and I just said, what does this mix grow? So you get a 70-30 here, and then by the end of this growth rate, it becomes the other way around, where NAND actually outruns and becomes a bigger piece, kind of three. If you're following this example, if this is billions, this would be 3 billion to 2.6 billion. But again, these numbers are just to show the weighting, and what I do is then I take a growth rate on this consolidated number, and I get a consolidated growth rate based on the numbers that they gave me in the presentation. It's their most recent quarterly presentation. I think it's Q2 of 2021. It's on their website. You can pull it up. But it basically says a 22% annualized growth rate for the year, if you believe their numbers and you want to use management's numbers. I like to haircut things, but I'm going to run with that just to see what pencils out, and then we can judge the IRR against how risky this is. To do 20% every single year for a decade is a very, very tough challenge. So I would expect an IRR that is materially higher than the market IRR to compensate me for taking the risk of just having this run out like that. So let's see what we get. So here when I forecast, I take my EBITDA from last year and I multiply by 20% and I run it out 20% every year. Again, very aggressive. You know me, I don't normally do this. We always drop this, but I just want to see, based on their number, they're saying those are long-term growth rates. I want to see what happens. So I got $10 billion here, goes to $50 billion, becomes an absolute behemoth. That's 5 times your EBITDA growth. I get an EBITDA market multiple of 6. I'm just using the average historically that's in here. I'm not changing the multiple. No market multiple expansion for this business. I get a $320 billion enterprise level. I got a little debt, some cash based on historic average. I adjust less the debt plus the cash, gives me a market cap of $266 billion. I divide by the current shares outstanding, and I get a long-term price target of $240 per share. Okay, now we're going to forecast free cash flow. We do the same thing. We pull the free cash flow per share number. I think it was 65 cents the last time I saw it. I pull the same growth rate numbers that EBITDA grows, because we saw that free cash flow from operations is in line with EBITDA, and you've got the CapEx, which is basically almost 100% of the free cash flow from operations. So I think this number, barring any financing changes, would stay relatively similar to EBITDA. I think that's realistic, given that most of the free cash from operations is being spent at CapEx. So I run that out. I go from 70 cents to $4. I do a 4% yield, again, based on historicals, excluding those 2 outliers, and I get a $100 price target. So we have 2 price estimates based on 2 different valuation methodologies. So what we'll do is we're going to look into the public market. I can buy the shares right now for $80. And I've got my two price estimates, $100 and $240. That's a monster range, by the way. I'm going to split the difference. And I think the range is really because so much of the free cash flow in 2020 was chewed up by CapEx that the cash flow from operations is really, really weak in last year. And so that's why this number is probably a little low, but it doesn't make much cash flow. So I'm going with it. I'm going to average the two to give me just a target out 10 years of $170. And what we're going to do is we're going to put this into an IRR calculation. And that IRR is going to say, here is my free cash flow per share. I buy the stock now for $80. I sell it at $170 out a decade from now. This is the kind of the net cash flows because I own the business, and this is the business's cash flow that they produce. They can dividend this out. They can buy back shares with it. They can go make an acquisition, right? Because it's true free cash flow. It's after they put all the money back into CapEx, after they make the debt payment. It just piles up on the balance sheet, and the stock price will always adjust for the cash on the balance sheet, much like I do here. So this is either dividend to us, they use it to buy back shares. If they bought shares, then my share number in here would be lower, which would mean this number is higher. So you always get compensated one way or the other. It doesn't have to be dividend, but it is reflected long term. I assume dividend here to make it simple. Long story short here, you get an 11% annualized return here over this time frame. I think what this is saying is that we are currently in a very robust stock market where companies that have a lot of promise, or even some that don't, get a tremendous valuation. Look at the SPAC investments that are out there where people are basically saying, give me your money, I promise I will go buy something that's going to be billions out in the future, but you have no idea what they're going to do with it, and those are getting funded like crazy. I think that, along with some of the EV companies that have recently gone bankrupt or the CFOs have left, been kicked out, still have value in stock price because there is so much money out there. And what's happening is companies like this who put out forecasts of 20% annualized growth rate for a decade, right? A decade, 20% a year. The market is taking that on face value and is saying, management, we think you can do it because this 11% is basically the 10% or so that the S&P 500 would do in any given decade in its history is about 10%. So if this is a market return, that means that the stock market is accepting management's forecast as the truth and have fully priced in this growth in the shares of $80 a share. And I don't think that is an appropriately risk-adjusted number for the forecast of 20% growth every single year based on the up and down that we have seen when we looked at the historical financials. So for me, I give it a wild meh. Let's review our numbers. We've got top line revenue growth. Yes, it meets it. Earnings growth. EBITDA was positive and growing. Yes. Strong free cash flow. No, it's not. They put a lot of cash back into CapEx. Low debt, yes. Well priced, no, I don't believe it is. So I'm giving this a meh. It seems to pencil out here, but I don't like the risk-reward ratio. Let's do one more thing. Let's take our normal adjustment that we do for growth rates, where we take the 20% that they're saying they're going to do, and I think near term they're going to hit this number, fine. Even next year, I'm like, okay, fine, they can still do 20% because semiconductor are in big demand right now. Fine, I'll do that. But over time, as other semiconductor manufacturers also expand and build capacity, you would think that this growth would slow down because the market's going to get flooded with installed capacity as every single manufacturer now that we've looked at has expansion plans. So that means that this demand is going to get sucked up, and what I'm going to do is I'm going to take off some growth rate every year and bring it down to something that's a bit more friendly, right? So now I'm haircutting their growth rate, still strong, by the way, still double digits. I'm not taking anything away from them, but I'm just haircutting a little bit. And I'm saying, okay, leave everything else the same. Long term, this took $100 out of that price target. Long term on this one, it took $40 out of that. So if we go over here, I've got my 80, I've got my new price target is now 109. That's $70 less than what we had. And I put it in here and I get a 5% annual return. So this is, for me, it's not something that on a risk-adjusted basis, I would put my money in. I think there's a whole lot more of attractive options out there, particularly in the semiconductor industry, which I will continue to look at to find something that's got the installed capacity, has the market presence, can maintain pricing power, and can grow on a consistent basis. Let's go see what else we can find out there. This has been Micron Technologies. I hope you enjoyed the review. I had a fun time doing it. Take a look at it. If you like this kind of material, if you want to learn how to read a 10K, how to forecast, how to risk adjust an IRR, I do teach a course on investing. I'm happy to give you this tool so you can go value whatever company you want to look at. Please check me out at cashflowinvestingpro.com, where I go through and detail this course in a 3-hour series that teaches you how to do just this for yourself. Either way, thank you very much for watching. I greatly appreciate the support. Let me know what else you'd like to see. This is a channel that's dedicated to cash flow investing for companies that are well priced, low debt, produce a lot of cash, and grow. That's what I want to find. There's a lot of you out there in the channel, in the comments, giving me great stocks to look at, and I hope that all of you go through those comments. Let me know what you want to see next. I'm happy to review it. My name is Cameron Stewart. This is Rational Investing. Thank you very much for the time. Greatly appreciate it. Have a great day. Bye-bye.